It's been another difficult week in the efforts to stop the spread of the coronavirus. The death toll here in the U.S. now tops 167,000, with thousands more deaths this week alone. And it comes as local leaders struggle with how to reopen our schools or keep them open in areas where fall classes have already begun. Let's talk about this further now with Dr. Howard Koh. He is a professor at Harvard's T.H. Chan School of Public Health and a former Assistant Secretary for Health at the Department of Health and Human Services. Dr. Koh, good to see you this morning. You know, this reopening of schools across the country seems a bit chaotic. Is this just another sign that our response to COVID-19 in this country is fundamentally broken?
Well, unfortunately, Alexis, that's a good summary. You know, we've had a patchwork response since the first case of coronavirus in January. And here we are into month seven and counting. We still don't really have a unified or national plan for going forward. So with respect to schools, the overwhelming issue is the level of community transmission in the state or city. So if there are places around the country where transmission's high, cases are rising, deaths are rising, and test positivity is still high, it's going to be very, very difficult to come to consensus about how to open. Having said that, there are other places in the country like New York where the cases and deaths have dropped for quite a while. Test positivity is now 1%. So there is ongoing, very important discussion about how to reopen it in places like New York. But these are really difficult decisions that will require the input of students, families, parents, teachers, staff, and local health officials.
Doctor, what would you advise local school boards to do? For, there's schools certainly that have access to high-speed internet and the resources to make remote learning work well for them. But as you know, there are just countless schools that don't have access to either.
That's a very important question, Brian. And one very disturbing dimension of this pandemic has been the inequities that it has exposed. We're seeing particularly communities of color that are under tremendous pressure right now because there are high rates of cases and deaths and transmission. And then schools there are going to have even harder challenges to reopen. So this is where we need federal, state, and local coordination as much as possible. There is funding that has come down from Congress. There should be more, and we're waiting to see after the break when more stimulus money is coming. Schools need support right now because if they reopen, they're going to need more funding for IT capacity, for partitions in schools, for more equipment and ventilation resources. There are so many dimensions here that have to be coordinated to get schools back on track.
Doctor, what is the role of testing and rapid testing when it comes to reopening schools? Should that be part of the protocol? I mean, I have children myself. All of their schools are saying we have to take their temperature before they go in. Their temperature will most likely be taken when they get to school. That's sort of it. What about testing, and how important is that to keeping schools open?
Well, Alexis, that's a really important question. So just yesterday, the White House put out 8 criteria by which schools should reopen. Reemphasize some very important public health guidelines the CDC put out a couple months ago. And they were important as far as they went, talking about social distancing and hand hygiene and those sorts of themes, but they did not mention testing at all. And in fact, there's been very little research and guidelines and discussion about testing protocols in schools and colleges. So just last week in the college area, a very important study came out in JAMA recommending that college students be tested perhaps as frequently as every other day. So we need more data, we need more science, we need more national leadership to resolve that very important question you just raised, Alexis.
Doctor, you teach at Harvard, which is all remote learning now. How has that situation changed how you teach students?
Well, we've all had to adjust. We've been teaching online since mid-March, actually, and we have a global student body. So coordinating students across time zones and people from around the world is not easy. But there is a commitment to go forward, and everyone's trying to be as flexible as possible. What I'm pleased about is we've had these decisions made after very inclusive conversations from all parts of our academic community. And I'm sure that that's the only way that we can do this for schools and colleges anywhere going forward. And this is critically important, Brian, as the fall is coming and seasonal flu is on the horizon. Vaccination campaigns will start there. And so, again, the communication and coordination while tracking the data and trends in the surrounding community is critically important.
Dr. Howard Koh of Harvard's T.H. Chan School of Public Health, thanks for being with us, and good luck with the start of the new school season, Doctor.
Thank you, Alexis. Thank you.
Still to come, a look at what's moving the markets here in the early going as we wait for the opening bell, just about 8 minutes away. We'll be right back. Stock futures are mixed. Want to check in with Jared Blickery. Jared, story catching my eye this morning, that deal between the government and Kodak on hold right now. What's going on there?
Well, we have a shareholder lawsuit proposed to be a class action, and you knew this was coming. It's only been fewer than 3 weeks since the actual event, and that was when Kodak initially got that $765 million loan from the government, and their stock had jumped the day before. It suggests there might have been some insider dealing going on, and there's already an SEC investigation into this, so not looking real good for Kodak. And we see the shares are down about 1% here in the pre-market. And if we look at what has happened recently, look at that spike to $60 and then coming down all the way to $9. Incredible price action there. And only days ago, the story got even more bizarre because a board member, George Carfunkel, he actually
Culver's is a family restaurant. To me, that means being the place that puts a smile on everyone's face.
Seeing normal, but one key less talked about space is actually catching a boost due to an increase in shipments from e-commerce purchases and a jump in home building sentiment as well. And that would be truck stops. The opportunity is largely controlled in the US by 3 companies, the largest 2 being privately held, including the top dog in Pilot, which even attracted an investment from Warren Buffett 3 years ago. But the third largest is Westlake, Ohio-based Travel Centers of America, which trades on the Nasdaq and is up more than 50% since reporting quarterly results at the beginning of the month, when the company revealed a nearly 80% increase in net income over the same quarter a year ago. And joining us now for more on that momentum and the opportunity ahead is Travel Centers of America CEO John Perchick joins us now. And John, thanks for coming on. I'm having this discussion. My own father was a trucker for a little bit here. So talk to me about what you're seeing during all this, because we've seen such pain in a lot of these services, but trucking apparently not one of them. So what are you seeing right now?
So, trucking were viewed, and all related things to trucking were viewed, of course, as essential services. Truckers have been really, through all of COVID, things are moving on the backs of trucks. And so the business dropped off a bit, but has continued to do pretty well. And for us, we've done at least as well in terms of diesel volumes through the second quarter than we did last year, which is pretty amazing. Some of our businesses, like the full service restaurants, were quite a bit down. They were not essential, but the rest have done well and frankly continue to improve.
And on that front, I mean, I'd be remiss if I didn't dig into why we saw net incomes improve so much in the quarter. You did make note of furloughs for your guys' as employees, specifically, I guess, tied to some of those restaurants that were closed. You have about 50% of those that were closed back open. But talk to me about how that's sustainable, since obviously you can't furlough workers for the rest of the year. But what exactly are you doing to kind of change that? Since I know that it's not just furloughing workers, what else is going on to see net incomes improve so much?
Well, partly the furloughing, I think, put a spotlight on a part of our business that probably was fairly inefficiently managed in the past, and those were our full service restaurants. And that's one of the takeaways. And so we are very focused on managing very differently. I've been here 6, 7 months, and we have a whole new leadership team in here, and we're doing things very, very differently. In addition, nothing to do with COVID, we undertook a comprehensive corporate restructuring where we pulled 13 million in actual run rate savings. That's 8% of corporate SG&A we pulled out. And within that, actually brought in a whole number of new SVP leaders who are really, really warriors and really strong, at what they do and are making very different decisions every day.
Well, you're heralded as a turnaround guy. And as you said, I mean, starting a few months ago here, you're really thrown into it with the pandemic hitting here as well. But over the last few months, you guys highlighted a bit of an uptick here, not just in April to May to June, but also in July, continuing that trend line, doing better even than what you saw in prior year over the month of July. So when you talk about the turnaround that's going on right now, even during COVID, as a turnaround man, what right now has you most excited to see these trends continue? If a lot of these catalysts, not being just e-commerce, but also home building sentiment here, what do you want to capitalize on the most?
Boy, it's pretty boundless. I mean, with the entire new team and an entirely different perspective on how to run our various businesses, we have so many areas, and we are just getting started. May 1st is when we onboarded the new team. Imagine finding and onboarding senior leadership during something like COVID. I mean, it's hard enough. And we've done that. We're only 3 months into it. So this team is really just getting started. The way we purchase things, the way we procure was not really in a consolidated, organized fashion. We didn't benefit from our Fortune 500 economies of scale purchasing power. We very much are now. So in general, how we buy stuff, we're dusting off and initiating a new set of mission, vision, and values. I think we're going to be pretty powerful to kind of pull the 20,000 plus people together, be marching to kind of a single drumbeat. So I'm excited about a lot of things right now.
Well, investors clearly excited about a lot of things right now as well, with the stock up, as I said, more than 50% in the last month. But John Perchick, appreciate you taking the time to chat, and good luck with everything out there.
Great. Thanks so much, Jack. Appreciate it.
All right, we're going to take another break here on the ticker. When we return, digging into large hopes here for a big summer blockbuster in the face of the pandemic, as well as the hurricane that also just came on shore. We'll chat both of those things and why theaters still think they got a shot to roll it out successfully. Stay with us. Welcome back to live market coverage here on the ticker. In this week's Fame and Fortune, want to spotlight an interesting change here versus what we saw at Disney with plans to launch a big summer blockbuster in Mulan, digitally going the other route for another big summer blockbuster here. And for more on that, we're joined by Yahoo Finance's Alexander Canal. And interesting here, Ali, to think about two different strategies at the same studio. Why? Why is this happening?
Right. So Marvel's The New Mutants premiered in theaters on Wednesday. Remember, last week we saw certain theater chains like AMC, Regal, and Cinemark partially reopen some of their doors. And they were hoping that this weekend would be a big one with the release of The New Mutants. But unfortunately, Hurricane Laura is complicating that reopening process. Some theater locations in both Texas and Louisiana are now having to shut down again due to the severe storms in that area, which is such a shame for the South that is really hoping to press that restart button when it comes to getting life back to normal amid this coronavirus landscape. Now, despite all of these challenges, The New Mutants is still expected to bring in between $8 to $10 million after this weekend. However, to put that number in perspective, pre-pandemic, this movie was expected to make around $20 million in its debut weekend, so about a 60% loss of profits there. Meanwhile, when we look at some new movies that are debuting amid this new reopening strategy, Russell Crowe's Unhinged, which made its official premiere last weekend, brought in $4 million to the domestic box office. And honestly, this is a pretty decent number considering the environment that we're currently in. It's certainly giving some hope to theater chains and yet to be released movies that there is still some sort of desire to leave the couch and get to the theater, even as the nation is still trying to grapple with this pandemic.
Yeah, kind of surprising. I'm sure, obviously, everyone's going to be watching the numbers out of Mulan when that comes out later in the year to see how it's faring relative to the opposite approach here we're seeing in New Mutants. But beyond that, obviously, a lot of consumers have options at their disposal when it comes to watching things, whether it be traditional TV or the new streaming platforms. What are we learning more about how those priorities might be changing as people get more comfortable with streaming?
Right. And once again, we're starting to see consumers just choosing streaming options versus traditional live TV. According to a new survey published by Hub Entertainment Research, 50% of respondents said that they default to an online or over-the-top platform as their first viewing choice. That is up from 47% from 2019. And then if we take a look at the other side of the table, those that are choosing live TV, DVR, VOD options, only 42% of respondents selected that as their first choice. That is down from 47% from last year's survey results. Now, if we take a specific look at that online category, those that are choosing those OTT platforms, Netflix continues to be the winner here with nearly half of those respondents, 23% of the 50, going with Netflix as their first choice. Now, the popularity of Netflix has been steadily increasing over the past few years and now trails live TV by only 7 percentage points versus a whopping 33% back in 2016. So that's some pretty strong and steady growth here. But you know, Zach, we always talk about millennials being the age group that is cutting the cord right now. But I think more and more we are going to see that older demographic hopping on the streaming wars chain. Within this survey in particular, those age 55 and older, less than half of those selected live TV as their first viewing option, and Netflix is certainly leading this trend. So it's going to be interesting to see what happens. And as I've mentioned in the past, the coronavirus is certainly accelerating that cord-cutting process.
Yeah, and I mean, not to be lost in all this too, obviously as Disney is looked at more as kind of a tech company here, as Disney Plus continues to grow, Comcast as well after Peacock has come out. We've seen shares in Comcast up by about 12%, kind of changing the way that we're thinking about them in this streaming environment as well. But Alexander can now appreciate that. That'll do it for us here in the 1 p.m. hour of the ticker, but stay tuned. We got much more coming your way. We already talked about that Apple stock split, but what about Tesla moving forward with their stock split of their own, hitting record highs again? We'll chat that with Tesla analyst Tasha Keeney right after this. Stay with us.
Welcome to Yahoo Finance Live. This is the ticker. I'm Akiko Fujita, and we are seeing green across the board with just 2 hours left to go in the trading week. Right now, the Dow up 85, the Nasdaq up 41, and the S&P 500 up 9. The Dow headed for its third weekly gain in 4 weeks, certainly looking to erase its losses for the year. And for the S&P 500, we are seeing it trading below the 3,500 level, but still seeing its best August performance since 1986. Energy and materials seeing the biggest gains in the session today. The healthcare sector, the biggest laggard. Ulta Beauty, a strong performance in the second quarter, lifting that stock today, leading the gains. E-commerce sales for the company more than tripled year on year. Certainly a story we are hearing from a lot of retailers in the quarter. A number of companies making news on the jobs front today. MGM Resorts laying off 18,000 employees that were previously furloughed. The company, though, the stock is up 4.5% roughly on that news. Coca-Cola also getting a lift on news of voluntary layoff packages that are now being offered to about 4,000 employees. The company saying this is part of a larger workforce restructuring plan. Some promising news on the economic front, helping improve sentiment in the session. We have U.S. consumer spending rising 1.9% in July. That is much higher than the 1.5% that was forecast. Personal spending also coming better than expected, rising 0.4%. We are seeing the bond market stabilizing after the huge swings that we saw yesterday on the back of the Fed announcing that change in its inflation policy yesterday. The 10-year T-note trading about or yielding at about 0.74% there. And we are seeing gold rallying, the precious metal up about 2% today in the session. Let's bring in our first guest for the hour. We've got Christina Hooper. She's a chief global market strategist at Invesco. And Christina, it's great to have you on this Friday. I feel like we have kind of been like a broken record this week, talking about records day after day. How are you looking at the levels right now across the board?
Akiko, it's great to be with you. And yes, this has been a really stellar week. I think it has almost everything to do with monetary policy. And it's not that dissimilar from the playbook we saw in 2009. Once QE started kicking in, we saw stocks really take off. They decoupled from the economy. And that's what we're seeing this time around as well. Things are very frothy because the Fed is far more accommodative than it was last time. And especially with the Jackson Hole speech of Jay Powell yesterday, it looks like the sky is the limit in terms of monetary policy accommodation.
How do you think investors should be looking at that, though? I mean, there's been so much criticism about just how frothy things have gotten. And to your point, just whether the Fed's policy is prompting a lot of investors to take excessive risk. You look at, for example, the tech sector. Today, we saw Bank of America's research out saying that the tech sector is now more valuable than the entire European stock market if you just look at the market cap.
Well, a lot of that is a function of how low rates are and just how awash we are in monetary policy accommodation. It really has altered risk and reward profiles, again, very similar to what we saw in the wake of the global financial crisis. You just have to look at risk assets, including stocks, differently in an environment like this.
And so how should investors be looking at their portfolio right now? Is now the time to maybe rotate some stocks or some of your investments, some of your money outside of tech, especially given where we've gotten this economic data? You know, certainly the recovery has been a choppy one, but if you look at consumer spending today, for example, we are seeing those numbers tick higher.
So we know that there are a variety of possible economic scenarios going forward, and there are so many factors at play. So it's critically important for investors to remember a key tenet, which is diversification. So while tech has done extremely well, it is really an important time for investors to take a look at portfolios and ensure that they are well diversified, not just across asset classes, equities, fixed income, and alternatives, but also well diversified within asset classes. That can sometimes be hard to do when parts of the market are so hot, but this is an important time to do that.
So what are some sectors where you see real opportunities right now?
Well, ironically, I do see a lot of opportunity in technology. So I don't think that investors should go underweight that space. I think there's some really compelling stories there. And quite frankly, in a low growth environment, typically secular growth and more defensive names tend to perform better. But it's important to be well diversified and have exposure to the more cyclical and really value oriented parts of the stock market in the United States. And of course, also be well diversified outside the US. And the opportunities I see there are in Europe as well as EM Asia. EM Asia in particular, including China, is very attractive because they've been able to control the virus very well. There's a strong contact tracing infrastructure, and they should benefit from a weaker dollar.
When you look at where investors stand right now, we've had a number of calls out on the street about how much higher the S&P 500 is likely to push. BMO Capital's Brian Belsky today coming out and saying that his S&P 500 targeted at 3650 year end. I mean, what do you think is the biggest risk to this rally right now, and what is likely to derail it?
Well, there are a few different potential risks, including the reignition of the US China trade war, including a significant spike in infections. Remember that we still haven't gotten to a second wave yet. If we're not able to control that well in the United States, that could certainly be the catalyst for a sell off as well. But I will give the caveat that I think even though we could see a significant sell off this fall, I think it would be short lived. The bias is upward for stocks just because of how accommodative monetary policy is.
You mentioned the US China trade risk there, and it does seem like, despite all of the rhetoric that's been going back and forth between the two countries, the trade deal has actually been the one positive. We got that readout this week that suggests that talks are continuing between the US and China. How should we be looking at that bilateral risk right now? Is it really about the trade deal being put on hold as a result of the election? I mean, what are other risks that you think could really rattle investors? Because up until now, it doesn't seem like that risk has really been baked in.
No, that risk is not baked in, but we saw what happened in 2019 when tensions flared up. And so there's always that potential, especially given that this is an election year, for there to be at least a real escalation in the rhetoric, but also potentially in actions. And I think that could certainly have an adverse effect on the stock market as it did in 2019.
And finally, the question I keep asking every one of our guests here is, what is the political risk we should be watching for, the election risk?
Well, I think the biggest risk vis-a-vis the election is the potential for there not to be an obvious outcome right after the election. And of course, if the election results are litigated, that could create a significant level of uncertainty. Now, we have been there before. Something similar happened in 2000. But to me, that's the biggest risk, which is another way of saying I don't see the election as a very significant risk, not certainly at the level of US China trade tensions.
Christina Hooper, always good to talk to you. She is the Chief Global Market Strategist at Invesco. Have a great weekend.
You too. Thank you.
Well, two stocks that have helped drive the recent rally, Apple and Tesla. Both shares have surged since announcing stock splits. Apple shares up about 18% since the end of July, and Tesla up nearly 40% since announcing this stock split. Let's bring in Tasha Keeney. She is an analyst at ARK Invest and covers Tesla there. Tasha, let's talk about what we have seen in the run up to this stock split. This is taking effect on Monday. As far as we understand, it doesn't change the fundamentals of the company, but it seems like investors just can't get enough of it.
Yeah, well, I think you nailed the point there, is that it doesn't really change the fundamentals of the company or the story. I think from our perspective, a stock split now, especially with fractional shares, shouldn't have that big of an impact. But of course, you could see, some price appreciation from investors basically sort of misunderstanding it, thinking that it might be cheaper. But the long-term story with Tesla, our thesis is still intact. We think it's a leader in electric vehicles, in full autonomy, and we think it's 3 to 4 years ahead of the competition on that front. So from that perspective, our expected value for Tesla by 2024 is still 7,000.
7,000.
Yes.
I mean, has the fundamental, that's a pretty high target when you consider where it's trading at right now. You mentioned that there's this fundamental misunderstanding of what a stock is, but we've heard a lot of investors or a lot of analysts who've come on and talked about the potential in the battery day, what could happen moving forward. I mean, is there a fundamental case for Tesla that has changed over the last month that has driven this stock even higher?
Well, I think I think in general this year there's been a couple things on Tesla's side. Of course, the earnings report was received well, the possibility of S&P inclusion, but really I think that during the coronavirus shutdowns, it's become even more clear. So if we just look at the electric vehicle opportunity, if you think of a traditional automaker who is investing in electric vehicles and basically how they're going to handle that when their core business is really sinking. I mean, that just becomes a lot more difficult. And they were already struggling with the technology. It's not their core expertise. They have to build an entirely new car. If you want to copy Tesla, that means building it from the ground up. That just becomes 10 times harder in a time like now. So I really feel like Tesla's leadership in the field is solidified. And then, of course, on the autonomous front, we still see Tesla has much more scale than any other automaker, than any startup, because it's using its customer fleet to collect data. So that's still ongoing. So, I think more so now than ever, it's sort of as an innovator, because Tesla's so far ahead, it now has that sustained lead.
There's certainly a lot of excitement riding on Battery Day later in September. What specifically are you expecting on that front?
Yeah, so my partner analyst Sam Course has done a lot of great work on the batteries for Tesla. So one thing that we're currently excited about is there was some teasing of basically an improvement in energy density that would make it so that batteries would allow for electric jets. So Elon Musk has talked about supersonic electric jets before, but said that the energy density wasn't there. Now he's saying that could happen in the next 3 to 4 years. What that means is that could be an incremental improvement for electric vehicles, but where it really makes the difference is for vehicles that fly. So this could enable things like electric air taxis. So actually, according to Sam's work, an electric eVTOL, vertical takeoff and landing vehicle, could actually transport you, for instance, in New York, from downtown to the airport for the price of a taxi today. So this could be, very disruptive, very quick. You could basically fly over traffic. And we think, this could be a fully autonomous operation. And I think it sounds like a very far out there idea. But the fact is we're actually approaching that point today because of these chemistry improvements.
So what you're saying is essentially we're not likely to, it's not about just the shift of Tesla going from a manufacturer to supplier with its battery technology, but being able to expand where they supply the batteries in place.
Yes, well, it could exactly. It could sort of open up opportunities for batteries across vehicle form factors. So we think batteries are sort of this innovative platform. One of the reasons we're so concentrated on them at ARC is because they enable disruption across a lot of fields. Electric vehicles is a huge opportunity, but it also enables things like drones. So this could be, in this case, the larger form factor drone that transports people or cargo. But you could also have drones that, of course, transport smaller packages. So again, this seems like a far out there reality, but it's here, it's now, and the technology is ready.
And Tasha, when you talk about the kind of levels you're expecting for the stock, upwards of $7,000, is the battery technology really going to be the catalyst to get it there? I mean, it's interesting. We've been talking so much about what has been working for Tesla, and the cars, the auto element of it almost seems sort of like an afterthought, given the potential you're seeing in its expanding business in other areas.
Yeah, I'm glad you asked that question because the expected value includes our assumptions for the core EV business, but also Tesla's position in enabling a fully autonomous taxi network. And actually, one thing in our research that has changed over the past year. So Tesla's talked about launching this Uber-like autonomous service. On the last earnings call, Elon Musk said that he's basically at this point where he can drive from his house to work with almost no interventions. He thinks they're very close to solving for full autonomy. With our most recent research, So let's say Tesla launches a ride hailing network with human drivers. They basically have to do this to learn the ins and outs of ride hailing anyway, and to seed the autonomous network, sort of that create the bones of it. But this is also an interesting business opportunity for them, because Tesla's costs on a per mile basis to drive a Tesla, it's actually cheaper than the average vehicle on the road, or than the average ride hailing vehicle. So what that means is Tesla could take a higher cut than Uber and Lyft off of revenues. It could actually pay its drivers more. It could offer, vertically integrated insurance offerings, because it's much more vertically integrated than the ride-hailing networks. And it could be a really interesting time to launch that right now with a coronavirus pandemic, because basically, there are these gig workers that are looking for work. There are customers that don't want to take public transportation, and Uber and Lyft are really hurting. So I think this could be a big opportunity for Tesla, and it actually sort of de-risks that autonomous thesis. Because if you think autonomous technology is crazy and it's never going to happen, well, okay, they can launch this ride-hailing network, and that actually gives them this software as a service like margin business model, this recurring revenue, without solving for that big technological leap. And if you do believe in autonomy, it also gives them the data to then feed that autonomous network and make it better.
Tasha, it's fascinating to look at all the parts that way. Let me ask you really quickly though about what you see in the Chinese EV market. We had XPeng, which is seen as a competitor to Tesla, come to market this week. We've also seen a huge run up in the stock for NIO, also a competitor, although that stock is down more than 6% today. Is that the case for growth in China still intact? And in fact, are we seeing it gain momentum now?
Yeah, so the Chinese market it's the most important auto market, and for electric vehicles, our forecast is 37 million EVs sold in 2024. China should be roughly a third of that. And actually, for autonomous taxis, we think the market value should be worth in the trillions at that point, around 4 to 5 trillion. And again, China could be a third of that. So it's a really, it's basically the most important market in both cases. In the electric vehicle market specifically, competition is very high. There's over 150 electric vehicle manufacturers in China. And it's a very unique market where the government has a lot of say in who wins. So that said, looking at startups like this, we don't think that a company like Tesla is going to be the only player in the certainly in the Chinese electric vehicle market, but also in the global electric vehicle market. I think it's really important to sort of see and watch how these companies get to scale. One important thing to look at for both of them is how much they're insourcing versus outsourcing. Again, because that vertical integration has been a really key advantage of Tesla's. It's very important when you're building a software platform on top of the car, and it's also very important for an autonomous network as well. But you also get the full advantage of your battery system, again, if you're sort of vertically integrated. So I think that both of those players are outsourcing some parts. So I think sort of watching that story and seeing what the end product will be, how much will they insource versus outsource, is an important thing to look at.
Tasha Keeney with ARK Invest. Always good to talk to you.
Great to see you, Akiko.
Coming up, TikTok reportedly nearing a deal to spin off its U.S. operations. We'll bring you the very latest on that front. Plus, college football potentially reversing course. The news coming out of the Big Ten on the other side of the break. Shares of Microsoft and Walmart are extending their gains in this session on reports the two companies are nearing a deal to acquire social media app TikTok. Oracle also bidding along with ByteDance investors, seeing that stock move higher as well. Let's bring in Dan Halley, who's been tracking all the latest developments on that front. Dan, it was just yesterday we were talking about why Walmart would jump in on a bid with Microsoft. And yet I thought it was interesting. Today we heard from interim CEO Vanessa Pappas on CNBC saying essentially there's a lot of synergies between these companies, especially because TikTok is trying to expand its e-commerce network.
Yeah, a lot of synergies. All right, whatever. There are some synergies, I guess. Basically, when we were talking about this yesterday, I was saying how TikTok has that younger audience, and Walmart might want that kind of data to know what they should be stocking and be able to bring in some of those younger users to their, I guess, flock of Walmarters. And that's really what it seems as though analysts are looking at as well. Basically saying, look, there's the opportunity here to extend e-commerce for TikTok to Walmart, making sure that people see products within the app itself and then purchase them on Walmart.com. Now, there would obviously have to be additional sources for you to purchase items. Maybe there would be deals for Walmart to make their products look more attractive. But from a revenue standpoint, you certainly would want to have a bunch of different advertisers on there offering some kind of shopping platform. But I think really Walmart would benefit greatly from this. It's not exactly a cool company, but if they can make themselves look cool via TikTok, then all the more better for them. That also goes for Microsoft. Microsoft isn't known as the cool company. They don't have the iPhone. They're not used for Gmail. And so I think this is a way for them to get those younger users in. But, I think at the end of the day, it really has to do with that e-commerce element. And that's the synergy. I don't see, any other real benefit outside of, advertising and the ability to purchase goods through TikTok from Walmart.
Yeah, and Dan, when you talk about what this could mean for revenue for a company like Microsoft, I mean, not even talking about an e-commerce play from Walmart, you look at the cloud side alone, we had this report from Bank of America saying that estimates on monetization of TikTok's user base could generate potential revenues of $630 million for Microsoft in its base case, $6 billion in a bull case.
Yeah, that's an incredible gap for, that's like me saying, well, I could have nothing or all of the money in the world. So, I mean, it's a huge gap. But yes, there could be that element that Microsoft could benefit for and Walmart could benefit for from this. It depends on how much TikTok is going to continue to grow. Right now, I think a lot of people who are younger really still want to stick to this app as much as Instagram wants to try to drag them away. It doesn't seem to be working as well. Reels, the Instagram TikTok knockoff, was getting very poorly reviewed as it came out. It's basically just a complete ripoff of the idea of TikTok. And I think people want to stick with TikTok for now, but going forward, this should be something that both Microsoft and Walmart benefit from. Oracle, it feels like now that they're not part of this, idea of the major benefits, that they're kind of falling back in the pack. Really, we haven't been discussing them very much. Obviously, there's the ties with the administration, the Trump administration, and Oracle, and how that could benefit them for the TikTok bid. But I think for now, really, it's looking more like Walmart and Microsoft.
And reports suggesting we could get an announcement in the next few days. So we'll be watching closely. Thanks so much for that, Dan Halley. Well, and the NBA is set to resume playoff games tomorrow after players boycotted the games to protest the shooting of Jacob Blake. Let's bring in Dan Roberts to break down the very latest on what has, Dan, not only become a basketball story, but a sports story. We've heard from a number of players and former players over the last few days. What are we now hearing from the league and the Players Association as they look to resume the playoff games?
Yeah, absolutely, Kiko. And first of all, I agree. This is totally sports-wide across all the major leagues. I hesitate to say it's unprecedented. In many ways, it feels like 1968, but certainly this is sweeping the whole sports landscape. Now with the NBA, where this started, the playoffs will resume tomorrow, so that's good. In the end, that'll be 3 nights in a row where the playoff games didn't happen. And the key here from the NBA and the NBA Players Association, which have just come out with a statement, I would point to 3 things that are happening. A social justice coalition that is being formed, and the daily for that coalition will be to listen to player activism ideas and try to make those happen. Second, teams where the team owners are the majority owners of the property, the arena where the team normally plays. Of course, right now, all 13 teams still left are in Orlando. But teams where the owners own their arena are going to try to use those as voting locations when we talk about the election. And that's going to obviously allow these players to really push civic engagement. Right now, they're big on saying that everyone should vote. And then we're also going to see more advertising spots for civic engagement and for social justice. We've already seen a little bit of that from the NBA, from the WNBA, from a lot of these leagues saying Black Lives Matter. But of course, that's just words. And now we're really getting into action. And I think the most interesting thing that has come out of the last few days, mostly from NBA beat reporters, is that LeBron James, who's obviously a huge leader, I mean, in many ways, it's LeBron's league, wanted to just end the season. And he originally voted to just walk out and end the season. The Lakers and Clippers both voted for that. Even though he supported the Bucks, who were the first movers here, and supported the boycott, he said, well, we need to have some kind of action. Like, ending play just doesn't really do enough. Now he is reportedly satisfied because they're getting the owners in the league and the Players Association all together to take more action instead of just putting out words.
Dan, let's talk about another sport we're watching closely. Some developments over the last few hours on college football. Reports that the Big Ten is now considering its fall season after initially postponing the fall games. What's changed?
Well, not much, right? And this story is kind of fascinating to me. I've been covering this closely. You're right. The Big Ten canceled, and we should say that the Pac-12 did as well. I guess we should say postpone, but it's important that we explain to people, no one really thinks that spring college football is realistic for a number of reasons. So even though the announcement initially from those two conferences was that they're postponing till spring, that seems like a pipe dream. So it really feels like they canceled their 2020 season. Now, those two conferences, the Pac-12 kind of explained, here's our reasoning. The Big Ten didn't. And it's a reminder that the Power Five conferences really operate completely independently. There's no commissioner of college football. So those two conferences canceled. The three remaining conferences did not and are moving full steam ahead. And now, sure enough, lo and behold, surprise, surprise, reports that the Big Ten and Pac-12 are trying to reverse that decision and are going to meet to discuss maybe starting their seasons around the time of Thanksgiving, maybe 1 week after Thanksgiving. They're still claiming that if they don't do that, they'll start in January, but I don't think anyone really believes that's feasible. Look, the larger story here is this time has just illustrated for everyone who maybe didn't realize just how much there's a lack of leadership in college football. The NCAA does not serve the role of a commissioner. There's no czar, there's no commissioner. And it's a reminder that these conferences that maybe canceled a little hastily, they expected the remaining three conferences to cancel. And I think when the SEC, ACC, and Big 12 didn't and said, we're still going to play, suddenly the Big 10 and Pac-12 said, oh my goodness. And of course, if the remaining three conferences play and it goes okay, and it's not a disaster, then you're going to see huge second guessing of the Big 10 and Pac-12. So that's why we're seeing reports that they're reconsidering. It doesn't necessarily mean that it's a guarantee that they'll reverse their decision, but boy, it's kind of a mess, isn't it, logistically?
I mean, Dan, you talk about the lack of leadership, but also, I mean, doesn't that just point to just how important the money is for these universities and sports? I mean, that's why we're talking about a restart in Thanksgiving instead of looking ahead to spring, which was the initial talk.
Of course. And I think what the average person does know is how important the football revenue is for the schools, not just for the athletic budgets. Football really funds all the other sports, but even in many schools for the whole overall academic budget. But I think what you have to think about also is all the different arms that are affected if certain conferences don't have college football. It's not just the schools and the students, the kids and their families and the parents and the boosters and local businesses in places like, where Ohio State is or Tuscaloosa, Alabama, all these businesses that won't get to set up shop, but also the networks that cover these games. I mean, just today, Pac-12 Network, which is owned by ESPN and Disney, had huge layoffs. And then Big Ten Network is owned by Fox. Those networks are in big trouble job-wise. And even if those two conferences don't play and the other three do, ESPN is going to lose a lot of money from missing out on certain Big Ten games. So there's so many stakeholders here if there's no college football in the fall.
Yeah, no question. It speaks to the challenge that so many businesses face, which is the safety element as well, but also the money element. Dan Roberts, thanks so much for breaking that down for us. The Ticker will be right back. More than 5.8 million Americans have now contracted the coronavirus. Roughly 181,000 Americans have died, far more than any other country. And in Michigan, the state is looking at a grim milestone, 100,000 cases now in that state alone. Let's bring in Dr. Payal Patel. She's an infectious disease physician in Michigan. And Dr. Patel, it's great to have you on today. Let's start with that milestone we're looking at in your state. What do the caseloads look like for you where you are? And how have things improved?
Yeah, I think that we were one of the first states to really hit a peak with COVID early on. We were seeing a lot of cases where I work, which is in Ann Arbor, as well as a lot more in near Detroit. What's changed over time is that Michigan is a very large state, and we're seeing more cases kind of spread throughout the state at this point. And testing has actually increased, which is great. And I think that's some of the numbers that are rising with the cases. We have currently less patients inpatient with COVID right now, but we're not seeing, trends all the way down. I think we're still seeing some oscillation along the way. So it's really hard to predict what the next months will look like.
You talk about the testing situation improving there. There are some questions about the new CDC guidelines that have come out that essentially says if you are not symptomatic, you don't necessarily need to get tested. And the question is whether the CDC put that out because of the strains that's been put on testing right now. What's the capacity where you are right now? Do you have enough test kits in place to get a good grasp of how the virus is spreading in the community?
Yeah, that's a great question. I think that, definitely in terms of how many tests are available and time to get your answer to your test, we have improved. However, there is still much distance that could be easier. And so, people have proposed home testing. There are some tests that are being run that you could actually have at home that wouldn't involve what some people call a brain biopsy, or, it sounds so scary to get tested. And I think that stops people from getting tested. Having an easier way to get tested and having a quicker turnaround, I think would really help people feel more comfortable getting tested. And we're still not there. And I think the infectious disease community is very behind more testing so that we can know who actually has COVID.
We've seen both the Republicans and Democrats put the coronavirus health crisis right at the center of their conventions. I want to play for you what President Trump said yesterday and get your thoughts on the other end.
We launched the largest national mobilization since World War II, invoking the Defense Production Act. We produced the world's largest supply of ventilators. Not a single American who has needed a ventilator has been denied a ventilator, which is a miracle.
Dr. Patel, you heard the president really sort of hail what he sees as a success story in the response. That line about nobody being denied a ventilator, we heard Vice President Mike Pence talk about that as well. What's the reality that you've seen on the ground when you look back to how things have progressed since March?
I think anyone looking at kind of what we've seen in the United States doesn't think that we should sit on our laurels, right? So I don't think that we should be necessarily celebrating at this point. I think we should really be thinking about where we are compared to many other countries and how they've done in their response and what we need to do to really bring the virus under control. And that really includes better testing, continuing the public health measures, because we're in the same spot that we were in April. We don't have a cure. We don't have a vaccine. And I think that's the problem, is thinking that we have somehow succeeded. We're still in this fight right now.
You talk about the politicization of so many fronts on the coronavirus. The vaccine is one concern. You had the FDA Commissioner Stephen Hahn walking back some comments he made about the treatment with convalescent plasma and the efficacy. Now we're hearing reports of a lot of patients concerned about any kind of vaccine that comes to market because of the way that it's been sped through. I mean, how big of a challenge does that present to you when you want more patients to get the vaccine when it comes to market, particularly because it overlaps with the flu season?
Yeah, I think you can't actually underline how important it's going to be to get as many people vaccinated as possible. If you think about the numbers every year, family and friends that listeners have that don't get the flu vaccine, I mean, we need to double those numbers to really get to what people want, which is herd immunity. So I think while we're waiting for the vaccine, instead of just relaxing, we should be actually focusing from a federal, state, and academic viewpoint on how to increase vaccine uptake in the entire country.
Dr. Payal Patel, infectious disease physician in Michigan. Great to talk to you.
Thanks.
We are off for another break. Coming up, we're going to be digging into the Fed's new policy on inflation. But before we head to break, some words of wisdom yet again from Warren Buffett as we look ahead to his 90th birthday.
If I gave you a car and it'd be the only car you get in the rest of your life, you take care of it like you can't believe. Any scratch, you'd fix that moment. You read the owner's manual, you keep a garage and do all these things. And you get exactly one mind and one body in this world. And you can't start taking care of it when you're 50. By that time, you'll have rusted out if you haven't done anything. So you should really make sure that you just remember that you just got one mind and body to get through life with and to do the most with it.
Well, the Fed's new plan or framework to let inflation run a little higher above 2%, facing a lot of skeptics, including from our next guest, who says the central bank risks politicizing the employment mandate. Let's bring in Marcus Schomer. He is a chief economist at Pine Bridge Investment. So, Marcus, let me just start by getting your thoughts on what we heard from Jay Powell yesterday. You saw the market reaction. What is this? What are the implications for monetary policy?
Hi, Akiko. Nice to be back on the show. I doubt there will be enormous implication for what the Fed is actually doing. Because think about what happened. This is like someone who tries to hit a target with bow and arrow and keeps missing. The arrows keep falling too short. And in response to that, instead of asking for a bigger bow or better arrows, they're going to ask the assistant to move the target a little bit further down the road, as if that would make it easier to hit it. That's really what we're seeing here. If this had been an announcement that we're changing the inflation target and we're rolling out these 3 new tools that will allow us to get there, that would have been an interesting story. But simply to say we have all the tools we need, we're just going to aim a little bit higher now, doesn't make it very credible. The biggest problem I have with it is communication. If you think about it, if we actually ever get to that situation where inflation is above 2%, and you have 2.8% inflation, and the Fed says, oh, it's no problem, 2.8 is fine, because the average is still below 2%, okay. And then a few months down the road, it's still 2.8%, and the Fed says, oh, now 2.8% is a problem. We have to raise rates because our average has now gone up above 2%. So 2.8 is good one month, 2.8 is bad another month. How do you communicate that to financial markets or to regular people? That's probably my biggest beef with the policy.
So how does the Fed manage that messaging? I mean, there are those concerns, you've heard them, about how higher inflation is seen as slower growth. And so if the Fed allows inflation to run a little hotter, that would sort of, discourage consumers, for example, from spending, because the implication is that the economy will get worse before it gets better on that front. How does the Fed sort of toe that delicate line in trying to stick to its policy, but communicate it clearly and transparently?
Basically, by not sticking to the policy. I mean, this is already kind of baked in the cake, right? This is another good example of a very one-sided policy that we've seen a number of examples of. This will work very well as long as inflation is below 2%, but it will stop working once you go above 2%. And then the Fed will have to change the goalposts again, which they will do by announcing that they're going to review every policy. They do a policy review every 5 years from now on. So expect something to change like this time, this year, every 5 years. It's the same story with yield curve control in Japan, by the way. If you look at the example there, yield curve control was, the idea is to anchor the 10-year bond yield at 0% or 10 basis points initially, which works as long as the bond yield is above the target. But once you move below the target, you then start selling bonds and trying to prevent interest rates, in this case bond yields, from going any lower. This was always a one-sided policy that stopped working once you got through the target. And this is another example. It will work as long as inflation is below 2%. Once we get above 2%, this will stop working. So expect by the time we get there, the Fed to change the goalposts and change the communication.
Marcus, one of the other concerns you raise is that this new framework opens the door for more political influence. You say it's the politicization of the employment mandate. What specifically are you concerned about on that front?
Well, it's the change in the way the Fed defines the unemployment or employment target, the second part of its dual mandate. There was never a numerical number for, let's say, the unemployment rate the Fed was targeting, but it was always seen as some kind of number that you can speculate where it is. As long as we're above it, the Fed would keep policy relatively easy. But once we go below that, there would be a risk of growing inflation potential in the economy, and the Fed would start raising interest rates. You can look at the Fed's own projections of what the long-term unemployment rate is, about 4.5%. So the idea was always, if you go below that, the Fed would there would be a greater tendency for the Fed to raise rates. But in the world we live in right now, rising unemployment is politically unpalatable. You cannot let the unemployment rate rise from whatever level it is. It becomes a big political issue. So now we're talking not about deviations anymore, but shortfalls. So the only idea is now, as long as we're below that magic level, we're going to keep interest rates low. If you go above it, it's fine. We're not doing anything. So it's basically accepting a completely flat Phillips curve. And the same thing will then also, I'm sure, apply to wages pretty soon. You will say if wage growth goes from 3% to 5%, the Fed in the old days would say, oh, let's raise rates a little bit. There's inflation potential building in the labor markets. In the new world, the politicized world that we live in, the answer will be, you cannot deprive workers from getting higher payments for their work, from getting higher pay for their work. So don't raise interest rates, Federal Reserve. So wages will also go into the category of don't use this anymore as a justification to raise interest rates. Basically, interest rates will remain where they are for the foreseeable future. That's really the message that we're getting from the Fed. They could have done it better. I would have used a corridor system around the inflation target and a greater forward-looking commitment to keep interest rates low. I think that would have been more credible, would have more sense, would have been easier to communicate. Unfortunately, they went with average inflation targeting, and I bet we will talk about this for a number of years in the future, the problems that it will generate, and then the changes that will follow as a result of it.
Yeah, no question. The debate on that policy just beginning. Marcus Schomer, always good to talk to you, joining us from Pine Bridge Investments.
Thanks.
And we want to get to some breaking news that we're getting out of Washington. Politico reporting that the White House is now searching for a replacement for Federal Trade Commission Chair Joe Simmons. He, of course, is a Republican who's publicly resisted President Trump's efforts to crack down on social media companies. We saw the hearing several weeks ago on that front as well, but Politico now reporting that the White House is actively looking to replace FTC Chair Joe Simmons because of his stance on social media companies. We're going to continue to track that headline and bring you any developments as they come in. We'll be right back. Less than a quarter of universities across the country are resuming in-person classes for the fall semester, and that is weighing on communities that rely on universities to drive the local economy. Let's bring in Mayor Steve Patterson. He is the mayor of Athens, Ohio, where Ohio University is based. And Mayor, it's great to have you on today. Let's talk about where things stand right now. You've got a population of roughly 24,000 in your community, but a big chunk of that comes from the universities themselves. What are you looking at right now with classes largely online for the fall semester?
Well, as you mentioned, about a third or 2/3 to 3/4 of the city's population is the student body. And with most of them being online, there are students that are doing face-to-face instruction, but by and large, students are taking their courses online. We do have about 5,000 to 6,000 students who are living in rental units off campus, juniors and seniors and graduate students. And with that, that's certainly helping with our local economy. But by and large, we're seeing retail sectors that are significantly impacted. Another big sector in the city of Athens that I would contend in a lot of college towns are the hotel industry, where you're expecting to have your hotel rooms, hotels full on move-in weekend. Things that are coming up that are not coming up would be homecoming or home games. So we're certainly seeing a lot of our business sector that built their worlds, their lives around the university and the university community. So there's a lot of disruption when it comes to the local economy.
You talk about the mass exodus that you saw back in March when universities were forced to close, 17,000 people essentially moving out overnight because of concerns about the virus. The hope was that the fall would allow these businesses to build back up. You just talk about the struggles they're facing right now. Can you put a number on it in terms of the economic hit your city has taken as a result of how universities have changed?
Well, as I mentioned with the hotel sector, what I can tell you is that two of our local hotels, at each hotel has already seen an impact of $1 million of revenue loss, decreasing their payroll by more than 50%, in some cases down to 35% payroll. We, on the city side, one of our largest water customers in the city is the university, especially with the residence halls. But since the resident halls are not open, or there's very few, less than 300 that are in the res halls, what we tend to see again is what we are seeing is a drop in city revenue in, say, our water fund by about $100,000 a month, which is a big impact on the city's budget. But by and large, the retail sector in the uptown area, they too, one business that has again built its world around the university, selling Ohio University paraphernalia, memorabilia, picture frames for graduations and whatnot, that particular business has reported to me that they're down by over $850,000 and not even, and we'll experience that going into the remainder of the fall. And to be honest, we don't have a clue as to what the spring is going to look like either at this point in time.
And Mayor Patterson, one of the other concerns that you have raised is the impact this is likely to have on the census. And you've pointed out that this all started back in April. If you don't get the right calculation here, what is the long-term impact for the city of Athens?
Akiko, I'm glad you brought that up. I think a lot of people don't think about this, especially in college towns, but with that mass exodus, the enumeration began April 1, and that's online, mail-in, phone-in. Field enumerations have just started this month. And with the rollback of the end of enumeration, which is the end of September, we are really fearful that we're going to see significant undercounts, in particular in our student census tracts. In 2010, one in particular, which is the vast majority is off-campus student housing, it was running at about 47.6%. Currently, it's running at 32.8%. So we are way off the mark when it comes to the head count. And to put a point on that for you, Kiko, what that translates to in terms of dollars for a 10-year enumeration period. So the next 10 years, we stand to lose somewhere between $2 and $4 million a year for things like the community development block grants, which is what we rely on for neighborhood improvements, street improvements, but also our schools.
$2 to $4 million. That is a huge hit. And Mayor Patterson, I appreciate you joining us today. Thanks so much for your time. We'll be right back. Welcome back to the ticker. We've got just about an hour left to go in the trading week. The Dow looking to erase its losses for the year. It is up 150 points roughly. The Nasdaq up 39 and the S&P 500 up 14. That does it for us here on the ticker. The final round is coming up next.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles Othem with you in New York on this Friday afternoon. Let's take a look at where things stand with an hour to go in the trading week, the last full week of the month of August. Right now, all three majors are higher on today's session. That means the S&P 500 is set for yet another, its sixth straight record closing high. The Nasdaq right now is trading 2 points above its record close. So we'll see if the tech index can hang in there and join the S&P for a record close on this Friday. The Dow is up 160 points right now, actually leading the way on a percentage basis, up about 0.6%. But again, the Dow remains at this point right around 800 or so points from its most recent record close. Remember, the Dow did close above 29,000 back in the winter before the pandemic sell-off. Right, taking a look quickly at some sectors here within the S&P. 9 of 11 sectors higher today. Healthcare, XLV, and communication services, XLC, the only two sectors right now that are lower. Materials and energy leading the way higher. And a lot of action on an individual name basis happening in the software names. Last night we had some earnings from Okta and Workday. Okta down about 4% right now, but Workday shares up 14%. And this stock continues, as a number of major SaaS plays, but Workday has been a standout among them, continues its rally here following its most recent results. And speaking of Okta and Okta enthusiasts, today for the next 2 hours, we are joined by special guest Jen Rogers. And Jen, sorry about the Okta miss, I guess. I know it's a company that you just love so much. You always remember your passwords. But just as we wrap up this week, what kind of stands out to you here in this market?
We can't leave Okta just yet. I mean, we can't buy stocks here, Miles, but I would like to say that when I first went out and sat down with the CEO and the COO, this was like a $20 stock. So by the way, I'm an idiot. I should have just done it and quit. But here I am. And it's really exciting to be here because, as you said, all-time highs. I think it's interesting. You noted the Dow is off of its all-time high, but we are on pace to be able to close out with no losses for 2020. And that's kind of crazy, right? I mean, look at all the ground we've covered here. And the Dow, as we all know, is kind of a funny index, and it's going to get a little bit crazier when we have Apple get its little split and some changes coming up on the horizon. But I'm just watching that to see if we can actually get out of here with our Friday. We will have 2020 with no losses for the Dow. And I'm watching all these layoffs. That's kind of where my head is. I'm also watching what's happening with Coke and with MGM. The story continues with big tech and the fact that like Main Street and the economy are doing something different than the stock market. That's okay. That's how it happens, but it can be a little weird.
Yeah, it does seem at this point that it seems that K is the letter that we've all come to and agreed that that's the letter of the shape of the recovery that we'll talk ourselves into as the most logical, at least as we kind of round out the summer here. Again, next week, last full week of summer with Labor Day weekend, just about a week away. All right, let's go to Jared Blicker now for a quick look where things stand, Jared, as you make sense of this market again, finishing up a week that, we only have one more trading day left in August, and this is a month that we talked about a potential warning sign for investors. The S&P here, though, is up just about 8% for the month.
Yeah, and the Dow is up 7.5% for the month. Just take a look at the Wi-Fi Interactive here. And we can also see that the Nasdaq doing very nicely. It is up 7% month to date. So it's actually up less than the Dow. And the S&P 500 is the weakest among them, up only 6%. But yeah, August typically has a lot of volatility spikes, and we really didn't get anything of substance here. But September, now this is historically the worst month for stocks since about 1950. And of course, we have a lot of market crashes in October, a lot of VIX spikes in these months here. So after Labor Day, people come back to the markets, we get more liquidity, and hopefully we will put an end to this summer. Even though it's been good for stocks, it's been kind of crazy for a lot of markets. Here's the VIX. Now, we did get this big spike up yesterday, and we came off today. You put it in context. Let's take a look at the 5-month chart here. Just kind of a little blip on the radar, and you can see really hit the highest level for August yesterday, but haven't broken out yet. Now we have kind of broken across this trend line, and a lot of times when we do that, we do see a spike. So maybe Monday, maybe next week, we'll have to see. Probably not going to trend down back to the pre-COVID levels, which would be around 15. But if we do keep above, let's say between 20 and 25, that has been the steady state of the market so far. Also taking a look at the 10-year T-note yield, and we backed off this morning, but we are right back up to 73 basis points, and we've been tracking this pattern now. It looks like we want liftoff. We'll have to see how far this carries us. And now a look at the NASDAQ 100 heat map. We can see Facebook down about 0.5%, Alphabet up by a similar percent, Microsoft 64 basis points. But the big winner today has been Workday. You already went over some of the software names. Western Digital also doing well, up over 6%, along with Ulta Beauty after reporting earnings, and then Trip.com and Marriott. So if we look at our, this is the wrong one. If we look at our travel heat map, and it looks like I don't have it right here, you would see a lot of travel stocks in the green today. And finally, a look at our leaders. And we're seeing the MJ Harvest Cannabis ETF, that's up 2%, followed by the chip stocks. The SOX is up 1.65%. K-Web, that's a Chinese internet ETF, and then emerging markets. Just in currency land, we've seen the dollar weaken to its lowest point, in 2 years versus the euro, and basically the lowest levels of the year, except for early January versus the yuan. So not a lot of tension with China being priced in the markets right now, Miles.
All right, Jared Blicker, we'll check in with you in about a half hour. We've spent so much time over the last couple of months kind of putting into buckets each of the outperforming trades, right? Jared talked about the reopening trades. You've got the hotels and the cruise lines and the airlines in there. Then you've got the stay-at-home trade, which tends to have, your Zooms, your Pelotons in there. But one stock that has more than doubled this year, and I think fits into an interesting bucket. I'm not really sure if we have a full bucket for it, and that would be Wayfair. The stock is up better than 250%. I guess it's sort of the home improvement bucket. Maybe a Home Depot's and a Lowe's goes with it. We saw those strong results from Williams-Sonoma the other night. RH is a stock that's had a very nice year. And Dan Roberts, you've looked at what has gone on with Wayfair this year. And is it really as simple as people are now stuck inside and said, I would like this place to look a little bit better?
Well, so I think there's some of the simplicity, Miles, of all the names that have had huge e-commerce gains. I mean, we've talked about it all week and last week, right? I mean, Best Buy, Online sales were up 242%. Walmart, Target, Walmart was up 97%, Target 195%. All of these big box brick and mortar retailers are seeing their online sales surge, or they did in Q2, and that makes sense, and that's sort of regardless of what they sell. But then with Wayfair, there's something happening in addition. And let's remember, Wayfair, home goods is its bread and butter. It's mostly furniture. There's some other stuff, but it mostly falls under furniture. Now, what was interesting was on the company's Q2 earnings call, which was already almost a couple weeks ago, and yet the stock resurging this week thanks to a couple upgrades, maybe thanks to a share buyback program announced last week. But on the Q2 earnings call, CEO Neeraj Shah said that he thinks home goods were up in particular, had a particular boost of any category, really benefited because instead of going out and instead of doing trips, people were at home. And also, since they were working from home, they looked around and, as you say, they said, well, I'm going to spiff up my place. I'm going to spiff up my setting here because now my home is my office. Now, that benefited Wayfair, but I think more than any of the other names, it also raises a potential red flag, right? Which is this just a short-lived thing? Is this a pandemic-only bump? Because if you take him at his word that people were buying home goods because of the pandemic and because they're stuck inside, well, is that trend going to continue next quarter? Is it going to continue a year from now? And Wayfair mentioned on its earnings call, it had 5 million brand new customers at its website in Q2, 5 million more than in the last 4 quarters combined. That's eye-popping, but are those people going to stick around and come back, or were they kind of one-time shoppers who thought, as you say, I'll try Wayfair because I need a new couch, a new rug, a new bookshelf, especially if I'm on Zoom calls with my colleagues. So Wayfair kind of belonging in that bucket with all the e-commerce names, but also standing on its own because it's really been a furniture play.
And also, of course, as you know, the subject of an internet conspiracy over the last couple of months, which is always exciting for any company.
Absolutely. And by the way, I mentioned in my story today as the kicker, but stock up 250%. 1 year ago, this company was mostly in the news because of an employee walkout over a political protest. So how things have changed right now, at least for the stock.
Yeah, certainly. Again, I think Wayfair is probably part of just a lot of companies that maybe we don't spend enough time on kind of in the mainstream media here that have just been huge winners. Now, many investors are going to be like, come on, you idiots. Of course, Wayfair is up this much, but we've got to talk about Tesla every day. So there's only so much time for the Wayfairs of the world on a show like this. All right, let's turn our attention now to what's going on at the Federal Reserve. Of course, a very busy week for the Fed. Yesterday, we heard from Fed Chair Jay Powell, and earlier today, our own Brian Chung talked to Cleveland Fed President Loretta Mester, Brian, about her outlook right now for where things stand at this point in the recovery.
Hi, Miles. As you mentioned, I chatted with Cleveland Fed President Loretta Mester. She is a voting member of this year's Federal Open Market Committee, so a pretty important person at the Federal Reserve. Asked her a little bit about what she sees as the economic forecast, given where the virus is in her district. Keep in mind that Cleveland Fed, the 4th district of the Fed, covers the entire state of Ohio, portions of Pennsylvania, West Virginia, and Kentucky. And here was her outlook for where the U.S. recovery is going to go from here.
By the end of this year, that GDP, the level of GDP will still be about 6% below where it was at the end of last year. The unemployment rate will still be quite elevated, certainly not anywhere near February's level. And so we're just going to have to really keep policy accommodative. And I also think we're going to need more fiscal policy to support households and businesses as we get through the reopening phase into a more sustainable recovery.
Saying right there that the United States still finds itself in quite a deep hole there, but she does say that the Federal Reserve will keep its accommodative policy, not necessarily a surprise given what we've already heard from Chairman Powell in the last FOMC press conference. But a few other things that I talked to her about, notably on the inflationary change yesterday. Keep in mind the Federal Reserve saying it will now tolerate periods of time where inflation is moderately above its 2% target. She said, we will need this to compensate for the period of time over the last 8 years where the Fed has undershot its 2% inflation target. And then secondly, also talked about the idea of just kind of where the Federal Reserve goes from here with regards to forward guidance. Keep in mind, everyone thought that the long-term changes yesterday will set the stage at some point for the Federal Reserve to pin liftoff to either inflation or unemployment or both. Mester saying that honestly, for right now, she feels communications is quite okay, even though she does say the committee will be deliberating this over the next couple meetings, plural. So you can read of that what you will, but it sounds like forward guidance might not be necessarily incoming as soon as the September meeting. But again, the Fed does have that on the back of their minds.
Yeah, and it just seems, Brian, from her comments that every Fed official right now has said till they're blue in the face, well, we're going to have to see what happens on the fiscal side. And then, of course, we get the headlines today that it seems like nothing is going to happen. And so you do wonder, to your point, where Fed discussions go in the fall if we get to October and there's still no additional fiscal support. And one assumes at that point there wouldn't be any until, I guess, January, when you have a new Congress sworn in.
Well, I think one concern here is that the Federal Reserve obviously will be holding on rates at the near zero bound for quite a while. We've heard Chairman Powell say the Fed's not thinking about raising rates. Maybe he'll say that for a fourth time once we get to the September FOMC press conference. But I think the challenge here is really going to be at what point does the Federal Reserve feel the need to start messaging what it plans to do at some point down the line if the economy does look like it's getting back to that pre-pandemic shape where unemployment was at 3.5%. Now, what we know is that won't be happening probably in the next year or maybe the year after that. Keep in mind that it took 8 years or so for the unemployment rate to get to 50-year lows after the last crisis. So we need to buckle in and acknowledge that it could be possible that interest rate policy won't be on the table or we won't be talking about it for the next 8 to 10 years, maybe. And that's not to say that I plan on automating my job and that you'll never see this Fed reporter again for the next 2 years. I'll still be watching if Fed communications change. But I think that what we focus on, things like the Fed balance sheet, things like whether or not they can unwind their liquidity facilities that they've launched during this period of time, those will likely become more in focus, not so much interest rate policy.
Well, I was just going to say, Brian, it's hawkish Fed reporters like yourself that perhaps put the pressure on the central bank at the middle of last decade to do something. How many times could they take the questions of what are you going to do? And how many times could Janet Yellen say, we're going to do nothing?
Well, Miles, I'm young, so I could change that in the next 10 to 20 years. Who knows, right?
The bias for action from the media, of course, once again rears its head as it comes to Federal Reserve coverage. All right, Brian Chung, great work this week. Talk to you soon. All right, coming up on the other side of this break, we're going to have our call of the day. Morgan Stanley looking askance at a couple of these sports gambling names here, downgrading DraftKings and Penn National. We'll get into that coming up here in just 2 minutes.
All right, guys, so just call it a day here.
All right, welcome back to the final round here on Yahoo Finance. Time now for our call of the day. Today we are talking about Morgan Stanley's latest on the sports gambling names, specifically DraftKings and Penn National, downgrading both stocks, downgrading DraftKings and Penn both to equal weight. Now, the firm does note both stocks have more than doubled since the start of the year. Both of these names have really been part of the reopening anticipation trade. And of course, we have some sports back, so that's positive for both platforms. Of course, the football season is really where most of the money and most of the excitement around sports gambling comes, but there has definitely been an anticipation of what that environment may look like as we get into the second half of the year. But Dan Roberts, I think this is a kind of a downgrade that we talk about from time to time, which is, well, if you listen to our upgrade, you probably made a bunch of money, and we are no longer, as analysts, going to stick our neck out there and say, hey, we think this stock is going to go even higher. We think that these names have probably hit some kind of an interim ceiling.
Yeah, I think these names just got too overvalued. That's how I interpret this call today. I mean, these stocks really ran high, and ironically, they ran high at a time when there wasn't sports. I mean, DraftKings and Penn and some of the casino names were up big in April and May when there were no live sports to bet on. And it was all the anticipation of how well they would do once sports returned. Now sports have returned, but let's also add here that DraftKings in particular, which has only been public since April, DraftKings has been a name that is very vulnerable day to day based on one sports headline. So when Major League Baseball had the first series of games since its return that had to be postponed or canceled due to a number of COVID cases, DraftKings stock fell big. Then when the two conferences that have canceled fall college football conferences, that is the Big Ten and Pac-12, when they announced we're not going to have football, DraftKings fell. Meanwhile, of course, speaking of news today, those two conferences now reportedly are trying to reverse their decision. So that's a mess, but also, lo and behold, I'm not that surprised because the three that haven't canceled are full steam ahead, and now the Big Ten looks kind of silly. The other thing about this note that I draw attention to, Morgan Stanley lists 6 reasons that they are a little hesitant on DraftKings now. One of them is increased competition from Barstool Sports. Well, but they're also downgrading Penn Gaming, and Penn is now the majority owner of Barstool Sports. About a month ago, we discussed on this show an upgrade of Penn that was based on the strength of Barstool, on the thinking that Barstool Sports, which has mostly been a content site, is going to get into the gaming space. So just kind of funny. It's kind of like, you know, these analysts can pick one thing to either use as a bullish or bearish reason at any given time. And suffice to say, the competition in this space is hot. You've got FanDuel, which is now part of Flutter. That's publicly traded overseas. So a lot going on. But if those two college football conferences do reverse their decision, and even if that doesn't happen, come September 10, when NFL returns, I think you're going to see these names surge big because when NFL starts every year, that's a huge time for new signups for these services.
Dan, I think that Barstool point is quite humorous because even in the section where they outline this potential risk for both DraftKings and Penn, the line here I want to quote directly is, from DraftKings' perspective, we are concerned that Barstool is more successful than expected, potentially taking share away. The industry in general has also become more competitive. But unfortunately, from Penn's perspective, we are concerned that the app is not as successful as hoped. So right now, they're just hedging their bets, right? We know that this analyst 2 weeks ago, prior to DraftKings' earnings report, had been one of the most bullish on Wall Street. So Miles, to your earlier point, after pumping it up, saying, okay, now we hit sort of the ceiling at this moment in time. And another sort of component to this research note that I think has been a common thread as a lot of analysts think about discretionary spending is specifically stimulus checks. Where are people getting the extra cash to kind of dabble in online betting, online gaming, buy kind of frivolous items, if you will? And so just thinking about that new audience base who may not have as much in their savings or checking accounts anymore. And we were just talking in the break about furloughed employees. It's just not a fiscally responsible decision, right? So that is a headwind that could potentially be in the works, as we still do not have another package on the table yet.
And I think the government is in play here in another part of the note as well. I thought the stimulus note and bullet was interesting, but also just, I don't know how much legislation there is out there talking about that in here. And I think I kind of took that for granted a little bit, almost like when we talk about cannabis as well. Like, oh yeah, it's fine, it's out there. We've jumped all those hurdles, or you can go across the tunnel and go place a bet in New Jersey. But in the note, they say the Louisiana legislature sent a ballot question to voters in November. There's also progress and hope, they say, but in places California, Georgia, Massachusetts, but none of those have passed. So this is still, look, it's still early days here. I just think it's worth noting, because sometimes I think, oh, well, this is done. Like, people can do it. And there are still hoops to jump through.
Yes, well, we have Dan Roberts on staff, so we get every little incremental update on what happens in sports gambling. And I too, Jen, have thought many times, isn't it legal in all 50 states? And Dan reminds me it's legal in 17? Fewer than that? I don't know. It's not many states, and it's less than half, I think.
That's right. And I mentioned earlier, by the way, that DraftKings has been a stock very susceptible to just one day of news. Similarly, there have been days when, X state is closer and closer to passing legal sports betting, and the stock surges 8%. Well, it didn't happen yet. I mean, you're right, Miles, in one case, which is a month ago, people were saying, okay, Massachusetts is doing it. Well, it'll do it when it does it, and it hasn't passed yet. And it is very, it has big swings, positive or negative, down just today, 7% because of the downgrade that you're talking about.
Yeah, always tough when a big part of your investment thesis, if it is for either of these names, is regulatory change, because that very slow going. Maybe it happens all at once, and then of course there are challenges, and lawyers lawyer. That's the one thing we know that they will do over time. All right, coming up on the other side of this break, we're going to talk a bit about what you need to know about a big retirement deadline coming up at the end of this month. We're back with that right after this. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Time now to talk a bit about retirement, and joining us for that is Justin Halverson. He's the co-founder at Great Waters Financial. And Justin, something that you highlight is an idea we've talked about several times during the pandemic, which is the required minimum distribution, which is basically how much someone who's hit a certain age has to take out of their 401k as they get older. And there's been some changes this year with the CARES Act and some things that folks maybe really need to know as we get towards the end of August. So what are you highlighting here, and what do people need to know about this rule change that's coming up in just a couple of days?
Yeah, Miles, I think it's very important to understand where as you were talking earlier, some people are looking for their stimulus checks to make ends meet. Ironically, there's a lot of people in retirement who are forced to take money out of their retirement savings vehicles that don't even need the money. And so they're on the other end of that spectrum saying, I don't want this money, I don't need it, but because I'm above age 72, the government's going to make me take it out. And so what happened this year with the CARES Act was they said you don't have to take out those required distributions. And so you can keep your taxable income lower. You can either pay less in taxes, or you could use that new room in your tax brackets to do things like Roth conversions or tax planning that can allow you to be more tax strategic for the future.
And I guess, thinking about this time for folks that are kind of either in the early stages of retirement or nearing retirement, it's certainly been a very scary year. But I guess in talking to clients and seeing these sorts of rule changes, have things in the CARES Act, I guess, in your view, really been retiree or saver friendly if we kind of take the totality of what's happened here?
Well, with this particular rule, I would say it is, Miles, because as I mentioned, keeping your income lower gives you more options for planning. But one of the problems I wanted to highlight today was the sequencing of these rules as the rules were made and as they were changed. And so because the law wasn't passed until March, if you already took out your RMD in January, for example, or February, you were out of luck because you already took the money out. And a lot of retirees that we serve do that. They want to get that requirement checked off the list immediately, so they're taking it in January. And so initially, when the law was passed, you could use the 60-day indirect rollover to do a one time per year. Any distribution within 60 days could be put back in. Well, unfortunately, the time the law was passed would have said that anyone who took the distribution in January was out of luck. Anyone with multiple IRAs or retirement accounts that they took distributions from also would have been out of luck because they could only do it one time, one account. And so that was the initial ruling that we saw, and it was almost mass chaos, at least on our planning team, trying to figure out how to help our clients make the most of this new law.
And Justin, thinking more broadly away from the specifics of this, I think about kind of calendar-based events a lot. Because on this show, it's like, oh, well, the market's up today. It's been up the last 3 months. Obviously, it'd be fine. But is there maybe not enough appreciation for the way that retirees and folks planning for retirement just say, hey, I want to do it Jan 1 every year, no matter what? And that might really change a lot of things, considering the Jan 1, 2020 to 2021 probably has never been more eventful, even though your financial account might say it was flat to up. I mean, a lot happened in the interim there.
Yeah, Miles, there's so many things to consider there. With this specific rule, thankfully, in June, finally, they made it right. They said, ultimately, we have until the end of August to put any RMD back, whether it was taken in January, whether you took multiples, whether it was from an inherited IRA, because initially, an inherited IRA distribution could not be put back. If it was from a work account, like a 401k, that could be put back as well. And so they made this one right. But just thinking through your question a little bit, things like Roth conversions, for example, we typically waited until November, December to do those, because late in the year is when we knew the retiree's income and we could plan accordingly for that Roth conversion. Well, this year we did them all in March when the market was at the bottom, because now all of those conversions have allowed the recovery to happen in the Roth. But I'd say the main thing, if there's any retirees on here that are watching right now that to consider, is your income planning. If you had to sell from those retirement accounts to get income when the market was down, you were forced to lock in losses. You couldn't wait until it recovered if you needed that income. And so you really have to be strategic, thinking about all the different changes to the markets, the laws, and everything else that's happened this year.
I actually wanted to ask you about the market and what impact being at highs right now has on your thinking, because in the same way that we think about dollar cost averaging on the way in, sometimes with these RMDs, it's good to be forced to take money out because, you're like, well, if it's going to keep going up, maybe I leave it there. And then September comes along and something else happens. So how do you think about it when you're at highs right now?
That's a great question, Jen. From the required minimum distribution planning, I do like that in normal years, it forces people to take money out of their accounts and forces them to spend and enjoy life. We call it, kind of see on my screen here, live retirement greatly. Our goal is for them to enjoy the fruits of their labor. You've worked so hard for this money. Trust me, your kids won't have any trouble spending it after you're gone. And so take advantage of it. But timing right now, I just had a couple of these conversations recently. despite our recommendations, against their own better judgment, a few people panicked and they sold everything back in March, for example. They're sitting on all this cash, and now markets are at all-time highs. Now they've got all this cash, and they're even scared to dollar cost average back in, because they know it's high and they're scared that it's going to crash again. And so it just says market timing in general. If you're a general investor, it just doesn't work, because not only do you have to get out at the right time, you got to get back in at the right time. And unfortunately, the emotional side of it causes us to sell low, and then now we're scared to buy back in and we don't know when to do it. Great question.
All right. Justin Howerson, he's the co-founder at Great Waters Financial. Justin, thanks for joining the program. Appreciate the time.
Thanks for having me today.
All right, coming up on the other side of this break, we'll take a quick look at the market here with about a half hour to go in today's trading session. Plus, we'll be joined by Chris McCann with 1-800-Flowers. He's the CEO over there. We're going to talk about their latest quarter coming up right after this. All right, welcome back to the final round here on Yahoo Finance. Miles Othen with you in New York. Let's go to Jared Blickery now for a look at where things stand with about 25 minutes to go in today's trading session. Jared.
We are adding to gains right now, and the outperformer is the Dow. You can see this on the Wi-Fi Interactive, up 82 basis points right now. That's over 230 points at session highs. Also looking at the Nasdaq, not quite as strong a day, but still up 0.6% or so. S&P 500 up 0.2%, pushing up against its session highs as well. And want to take one last look at the VIX because it's down for the day. But if you look at what's happened for the week, we did see that rise yesterday. And an important note from